Good morning and welcome to this Wednesday, June 7th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Let's see, coming off another big day yesterday in the market, especially with small caps. We'll get into that in just a minute. Currently looking at futures. Seeing that futures are mostly higher, but just barely. Dow futures up 11 points today. S&P 500 futures up 3.5. NASDAQ futures up 7.5. So all of that is less than 0.1% higher. Crude oil prices up 1.25% back to 72.65 per barrel. And the U.S. 10-year Treasury yield up 2 basis points, 3.72%. So that's where we look to start the day. We'll see what happens after the opening bell. As I've been mentioning this week, not really much in terms of economic news. The only other key report really that we have out the rest of this week, and we haven't had it much out to date, is tomorrow. Tomorrow we've got the initial jobless claims coming out, and that's a routine report that we see every week out normally on Thursdays. And that we're looking for 240,000, and last week was 232,000. So we're looking for a little bit of a jump there. But again, that comes out tomorrow, not today. So really not a whole lot out. Earnings news, pretty light. No major earnings from companies yesterday after the close. No major earnings this morning, unless you like some of the defensive names. We get Campbell Soup came out. But really not much in the way of earnings. So the market is left to trade on technicals and also left to trade ahead of the Fed meeting, which is next Tuesday and Wednesday. So, I'm kind of watching the action. I like what I'm seeing right now in some of the small cap areas, industrials, financials, banks have been performing a little bit better. So that's helping to lift some areas that a lot of technicians were worried about. I was not worried about it, because the groups weren't breaking down. They were lagging. There's no doubt about it. But if you look at daily 1-year charts, they had a big move in the fourth quarter of 2022, and they've just been kind of languishing since. They did okay at maybe individual parts of 2023, but really nothing like we've seen in technology, communication services, or even consumer discretionary. So a lot of eyes have been on that area, not believing in the rally. But the problem with that theory is that the market can come back in other areas when we get rotation. That's what bull markets are all about, rotation. When money leaves the hot areas, does it actually leave the market? Because that's what happens during cyclical bear markets. You get one area or a couple areas that might be hot for a couple of weeks, and then the whole market drops after that, because when the money leaves the leaders, it goes nowhere except on back to the sidelines. In a bull market, it's different. When you get the selling of technology, when semiconductors start to pause like they have over the last week or so, money rotates into other areas that start to take off. And so we're seeing that now with small caps. So let me go ahead and get this thing going. We're going to start off and show you what happened, excuse me, on Tuesday. So the Dow Jones Industrial Average up 10 points, basically flat. S&P 500 up 10 points, maybe a little bit better, but up 0.25%. Getting closer to that 43.05 resistance level. Closed yesterday at 42.83.85. So about 21 points away. NASDAQ up 47. Okay, things starting to get a little bit better here. NASDAQ jumped about 1/3 of 1%. And then more of the excitement kicks in. Mid caps up 51 points, more than 2%. Small caps up 33 points, almost 3%. This is the second major up day in the last 3 for mid caps and small cap stocks. So, I feel like this is a kind of a key area on the charts, because as you look at mid caps clearing the congestion area that they've been in for the last 3 months, and you see small caps clearing the congestion area that they've been in for the last 3 months. If you recall, the NASDAQ, when it finally cleared, we got that big month in January and cleared a lot of the previous highs. You know what happened after that? We continued higher, and the NASDAQ did extremely well. I think we could be in for something similar here in mid caps and small caps. And that's why I've been saying for the last couple of weeks, accumulate small caps. The money has been rotating. We've seen money rotate from value to growth, especially in the small cap arena, since March. During this drop right here, everything looked bad on the surface. But if you dug a little bit under the surface, you'd see that small cap growth was crushing small cap value. The opposite normally happens when you go down. Normally, it's the growth stocks that get hammered when the market is weak. Not the case here. I'm not saying small cap growth didn't go down. What I'm saying is that small cap growth was getting the rotation from small cap value. So if you're thinking, okay, that downtrend is going to continue, we're going to really be in big trouble. Why would the market be rotating into the small cap growth over value? It makes no sense. That's why I don't just look at the numbers. Technical analysis isn't just about looking at the price action on the surface. Technical analysis is about a lot more than that. Got to dig deeper. And hey, everybody's got their own charts that they go to. I'm a big fan of growth versus value, aggressive versus defensive. That's not my number one primary indicator. My primary indicator is price and volume. What you're seeing right in front of you is my primary. But I see the mid caps and small caps going down with signals suggesting it's not going to last. What did we talk about a year ago with the NASDAQ? Did I not talk about the exact same thing? When we hit the June low versus the May low, I said money is rotating into aggressive areas. That's bullish. I can't be bearish when I start seeing that. What has happened to the NASDAQ since? Everyone's like, oh, large cap growth, large cap growth. Well, that's what large cap growth was telling us a year ago. If you wanted to look at it and listen to it, and now small cap growth, mid cap growth, it's telling us the same thing. And now we're starting to see the price action go up. Financials led yesterday up 1.25%, discretionary up 1%, energy up 0.8, 4/5 of 1%. Those were your three leaders yesterday. So discretionary, one of the aggressive groups in the top three. Financials actually an aggressive group. It's just a little bit more stick to the S&P 500. It's not really, when the market takes off, I don't really look for financials to be the major leader, with maybe the exception of the fourth quarter. Historically, financials and industrials do well in the fourth quarter. Outside of that, I'm not really looking for leadership from financials or industrials. I just want them to go along for the ride. I want them to be going up, not necessarily going up faster than everything else. Well, yesterday financials did go up faster than everything else, which is good to see. Got a downtrend. Certainly we need to break. I find this interesting though, down at the bottom. Look at where the financials were back in February, 37-ish. We just got down to 31 and change. We just moved back above 33. So we're still $4 below. Look at the AD line. Another flashback to 2022. I kept talking about the fact that the Dow, the S&P, the NASDAQ kept showing the AD lines strengthening, breaking out during periods when those indices were off of their highs. It's just a signal that there's afternoon buying, that we're getting enough buying in the afternoon to offset the weakness that we see in the morning during amateur hour, I like to call it. You get your gap down, you get your morning weakness, and then boom, everything seems to be fine after you get past 10 or 11 in the morning, Eastern. It's like, what bear market? That started after the May bottom last year, when we really started to see that pick up in terms of afternoon buying. I said we were all being manipulated. Turns out, guess what? We were being manipulated. Look at what growth stocks have done, what technology's done, what the major indices have done, especially the NASDAQ. They've moved back up significantly. So anyway, those were your three leaders. To the downside, we have healthcare and staples. So healthcare down about 0.8%. That was your laggard on Tuesday. Consumer staples down 0.5%. That was the other laggard. By the way, both defensive groups. Moving on to the 10-year Treasury yield. Again, only one key economic report coming out this week. That'll be on Thursday, tomorrow. In the meantime, this is what we've got to look at in terms of the 10-year Treasury yield. We got a nice little uptrend. Pulled back, held the 20-day. We're trying to bounce off of it. That's pretty good short-term uptrend. I'd say it's still in play at this point. Pull back below 360 would kind of question that. And I've been saying, you know, the 10-year Treasury yield bond market to me is more confusing than the stock market right now. And I'm beginning to think that maybe we're just kind of morphing into a different period for the 10-year Treasury yield. We had that huge long-term 40, 50-year downtrend that culminated with the pandemic where we went down to almost zero. And then we bounced back hard. We've broken that long-term downtrend line. Let me show you what I'm talking about in terms of long-term. So here's your monthly. I'm going to go back. Let's go back 50 years. So here was your 1981 high, up 16%, whatever it was. And if you connect all these tops coming down here, you'll see that we had a pretty significant downtrend. Well, on this move back up, that downtrend line's been broken. So, you know, I had been saying that I thought maybe we'd go back down to 2.5, maybe below, and we still might. But I'm also kind of thinking maybe we just go sideways for a period of time. Maybe next couple of years, we just trade in a range. Maybe that high that we saw, 4.25, maybe we break, maybe go a little bit higher. I wouldn't want to get through 5. I think 5 is kind of an area where I would start to get nervous about what impact that might have on stocks. But below 5, I'm still okay with that. To the downside, maybe we get to 2.5, but 3, you know, if we get 2.5, 3 to the downside, 4.25 up to maybe 5 to the upside, I think the stock market can still do fine. We saw that back in the 1960s, by the way. We came out of having very, very low rates. And throughout the 1960s, that remained part of a secular bull market, even though rates went back up into the 4s. And I think by the end of the 60s, we're up into the 6s. And that's when things started to turn back down for a secular bear market. So I know a lot of folks are talking about, well, you know, the fact that rates have gone up so much. Well, they've gone up from 0, though. I mean, yes, it's gone up fast. There've been a lot of hikes. But is there a lot of difference between 0.5% and 3.5%, 3.75%? Historically, as I've mentioned, there have been a lot of periods where the stock market's gone up with rates a lot higher than where they are now. And it didn't change. I mean, 1999, we had a move from 4% up to almost 7%. It was one of the best years in stock market history, at least for the NASDAQ. 1999 was crazy. Now, we did end up paying a price. You get back up near 7%. Again, I think that's a little bit high. So I think you've either got to be in a downtrending spiral in the bond market, or I think we need to stay below 5%. 5, I think 5 would be a little bit of a head scratcher for me, or at least it would make me pause. And you all know I'm pretty bullish. I get tired of hearing people say I'm perma-bull. I'm not perma-bull. If you think I'm perma-bull, then you're just bearish and you're just wanting to complain about something. There was nobody more bearish than me going into 2022 when we were at an all-time high. You need to go back and read some articles, look at YouTube videos. First 6 months of 2022, I was not bullish. I was obviously very, very bearish. So I just want to make sure that gets pointed out, because a lot of times there are comments saying, hey, he's perma-bull, all he does, but buy. Not at all. I call what I see. If I see it bearish, I call it bearish. If I see it bullish, I call it bullish. And those of you who say, well, what about this chart? Or what about this chart? Or what about this chart? Okay. Let me know when you see every chart in the market that is perfectly bullish or perfectly bearish. You're never going to see it. So if you want to pigeonhole and look for a chart here or there that looks bearish, fine, go ahead. I got signals that I rely on, and they are telling me bullish. The overwhelming majority are saying you want to be long and have been saying that to me for a year now. Mid-June last year, I flipped the switch. Couldn't have been any clearer. I said, I am calling the bottom. I'm bullish. Told our members I'm going 100% long from June. I mean, go back and look at the chart. Anyhow, 10-year treasury yield, we'll see what happens. I'm okay with it, though, in a trading range. So let's see what happens there. S&P 500, 4305. There's your number. There's the close for mid-August. Again, if you want me to point to one thing that still made me just a little bit nervous, maybe a little cautious, maybe it makes me, struggle sleeping at night, it would be this upcoming resistance at 4305 on the S&P 500. That's it. I can't see really anything else. Got up to 4,300 on Monday. And now we're back up. We'll see what happens. Futures up a little bit. I don't know. Maybe we'll test that 4305 today. Can we get through? This would just be a normal area to see a pullback. And what we might just see is, as I've been mentioning, rotation. To me, the small caps and mid caps look very strong right now. I mean, I think if you're talking from a reward to risk standpoint, after the huge run that technology and the NASDAQ made, and the fact that the S&P is now up against 4,300, I really like the breakout in the small caps, especially with that under the surface rotation that we saw prior to this move up from value to growth. So right now, I'm mostly in the small cap area. So anyway, 4305, that's the level to watch here. NASDAQ 100, I just think we're overbought. We could really use a little pullback, maybe to 14,000, something like that, 3-4%. Tell you what, if we keep going up, a week from Friday is options expiration. So if we do continue to move higher in the NASDAQ, there are going to be a lot of heavily traded stocks, those big mega cap stocks, Apple, Microsoft, Tesla, Amazon, Google, NVIDIA, many of the semiconductors. If we keep going up, there might be a price to pay as we go into option expiration week next week. Keep that in mind. So for those who are thinking, maybe leveraging the NASDAQ, I don't like it here. It's not that I don't like the NASDAQ. I'm fine. I have a position still in the QQQ. I'm just holding. But I'm not leveraging. Not when you've got this kind of a overbought situation. That's not when you want to be leveraged, in my view. We've had a big run. Take your money. Move back to the QQQ. If it keeps going higher, you're fine. But if you get a normal pullback, you don't want to be triple leveraged. I don't want to be. Maybe I shouldn't say you. You can do whatever you want. But for me, I try to manage risk. So in this kind of situation, I'm not interested in the QLD or the TQQQ. I can stick with the QQQ. Now, if we get a pullback in the QQQ down to the 20-day, that's when you might see me start to flip out of the QQQ and move more toward the leverage. But I'm going to do it when I'm near what I consider a good support area. I'm not going to do it when we're overextended. All right, going to go into the chart of the day. Before I do, I just want to mention, if you go over to earningsbeats.com, scroll down, got an area where you can sign up for our Earnings Beats Digest. We do have a chart that comes out 3 times a week, Mondays, Wednesdays, and Fridays. So we'd love to show that to you. It comes out normally about 8:30 in the morning, about an hour before the market opens. That's when we try to get it out. If it's a little bit later, it's because I'm usually running late, so you can blame me. But all it takes is a name, email address. That's it. No credit card. You can unsubscribe at any time. Name and email address. All you have to put in here, hit that subscribe button. We'll make sure we get you set up. So every morning when I publish this newsletter, it'll get sent directly to the email you provide. And one of the best things about this is that it allows you to attend any of our free events, because we reach out obviously to our paid members, but also to our free Earnings Beats Digest community. When we do free events, if you're on this list, we'll send you room instructions. So I think we're going to have a pretty big one coming up in a couple of weeks. I'm excited, but I'm not going to talk about it yet. But just kind of mark your calendar. A couple of weeks from now, probably going to have something pretty big that I think most of you will find exciting. There's some news going to be delivered. All right, I'm going to stop there. Anyhow, make sure you go over to earningsbeats.com, scroll down, sign up for the EB Digest. All right. So I want to show you the chart today, and this is similar to what I sent out in the EB Digest this morning to everyone. But here is the S&P 500 going back 20 years. And on the bottom here is the transports, also going back 20 years. This is a weekly chart. So each one of these candlesticks, can't really see the candles, but they all represent a week's worth of action. At the bottom of this chart, I have the correlation. And so right here, you can see with the correlation, this correlation between the S&P 500 and the transports. And it's looking at how well they move together or opposite one another over a 20-week period. So that's the default, 20 periods. So weekly chart, so over 20 weeks. If they tend to move in the same direction, the correlation will print readings at 1 or up near 1. If you move in the opposite direction, you'll have readings that come down here to -1. Now, when you look at the history of this, you can see that an overwhelming majority of time, we're above 0.5, plus 0.5 right here. And really, I'm going to say maybe half or maybe more of the time, we're above 0.75. In other words, there is a very, very strong positive correlation between the direction of the S&P 500 and the direction of transports. Now, this is not saying that transports have to lead the market. Doesn't mean transports have to be the best thing since sliced bread. It just means transports need to be moving up. Ordinarily, for the S&P 500 to move up. And so what I've done is I've drawn these vertical dotted lines. Blue lines represent bottoms in the transports. And then you'll see a move up until we have a significant top. That's the red dotted line. And then we pull back. When we hit a bottom in the transports, you'll see the blue dotted line again. And then we rally. And then the red dotted line, we pause, come back down. Blue line up. Hopefully you can kind of get the gist of this chart. All right. Here is what the uptrends look like on the Tran. I want you to focus on what happens to the S&P 500 when transportation stocks are going up, not when transportation stocks are relatively higher. It's not when they're just going up versus the S&P. It's when they are actually going up, when their absolute prices are going up. Look at what happens to the S&P 500 here. Transport's going up. The S&P over, 3 years, 4 years, up 69%. Here, we went up a couple years on transports, 99% up on the S&P 500. Here, almost 3 years in an uptrend on the transports, up 85%. Here, transports went up, maybe 2.5, 2 3/4 years. S&P went up 63%. Here, we bottomed, reached this top maybe a year later, 44% higher on the S&P. Transports moving up from the low to the high in this move. This was over less than 2 years, 100% up in the S&P 500. It doubled in 2 years while transports were going up. And then back in October of last year, when we bottomed in the transports, we're now in an uptrend. I believe we're in an uptrend. Now, obviously, I could be wrong. Maybe we turn back around. But right now, I think off of that low, we got higher highs, we got higher lows. I'm viewing this as an uptrend. So far, S&P 500 is up 22%. So I know everybody's talking about technology and how this market's not being led by anything but the big mega cap, you know, the Microsofts and the Apples and so forth. I agree to an extent. If you have a short-term memory and you're only looking at what's happened in 2023, I mostly agree with you. Transports did pretty well in the first month of the year. The last 4 months, it's been down, but it hasn't gone back down below the low. An uptrend is a series, higher highs and higher lows. I think unless we go back down below that December low, I believe industrials, or not, well, industrials too probably, but transports are in an uptrend. Are they not allowed to pause while money rotates into the big groups? They haven't broken down. I mean, here's a daily chart. I mean, here we came down. There was the low in September. Then we went up. Here was the pullback in December. So here was that major low. We go back to here to the transports. That was the low in September. This was the low in December. Right here, end of December. So I'm looking at maybe 13,250 as a very big level on this chart, because if we were to break below that low, 13,250, that would be another chart that I would put in the bearish column, because we know the history of transports. As long as we're in this pattern, higher high, higher low, higher high, and so far we're between these two lows, and it looks to me like we're starting to turn up. I like this break above the moving averages, the pullback to test it, and then the bounce off of it again. I think it would be really bullish if transports move back up and take out 14,250, because I'm already seeing this downtrend line. Let me annotate this. I think this downtrend line's now been broken. So right in about there, connect this high, these highs, these highs, these highs, all the way down here. And now we've gone up through it, gone back and retested it and reversed off of it. This is going to be a group I think really important to watch here in the near term. I think transports are getting ready to move higher. I think we've already started it, but I wouldn't be surprised to see us up testing this 14.5 area, breaking above that, and starting to really have a nice push back to the upside. I think that would be the next part of what I see as a very, very bullish market here in 2023. I've already seen a lot of confirmation. This breakout of this downtrend line, I think, is another piece of the confirmation, but let's see if we can extend it. Let's see if we can confirm it and move off of the moving averages and start trending higher. Let's see that PPO, which is sitting just below the center line. Another day or two, we will cross into positive territory. Instead of doing this, just barely crossing and going back down, what I want to see is a move through and continuation here. Like this, bounce off that 20 and move up. I wouldn't be surprised to see a big move up, kind of like that we saw. I'm not saying it's going to happen. I'm just saying I would not be surprised. I think there's a lot of money that's out there that's rotating right now. Options expiring. I think technology stocks could be a little iffy here for a little bit. I see the potential for a lot of money moving into areas like transports. So don't be surprised. Just like I was saying with the IWM. Take a look at that one now. Oh. Look at these big days right here. Nobody saw that coming, right? Unless you're an earnings beats member. We've been talking about this consolidation and how bullish under the surface has been. And folks were questioning it. Folks listening to the videos, these shows that I do, they're like, why? What the heck? Why would you want to be doing that? Well, why did I want to buy the QQQ 12 months ago, middle of June? I think you're seeing it now. So why would I want to be buying small caps? Well, here's another big reason. Take this chart out 10 years. What are we doing? Are we not uptrending? I see a double top on the IWM right at about 163, 164. Then we got a double bottom right about 160, 161. I mean, all we did is we had a huge run. We went back, we tested this area, and I think we're ready to extend this secular bull market. So yeah, we're getting a short-term breakout above 170-ish, or excuse me, 179, 180. I think we're going to get a breakout above 200. And I think not too far down the road, we're going to be back up 230, 240. I think this is the start of it. We'll see. I'm willing to stick my neck out in line. If there's one thing you know about me, it's that I have no problems with conviction, whether it's bullish or bearish. I'm going to tell you what I think. I'm not going to be right every time, but I'm going to tell you what I think, and based on what I'm seeing. You can argue, you can take the other side. That's what the market's all about. But I try to explain why I'm bullish. IWM, money is rotating into growth in small caps. We're now getting that first breakout. We're getting that PPO back above the center line. People, investors, traders, especially retail traders, very, very short-term memory. I shouldn't even say especially retail traders. I should also say professional analysts out there. Very, very short-term memory. All you can focus on is what small caps have been doing here. Nobody really talks anymore about the fact that before we had this pullback, small caps from the low from the pandemic to the high at the end of 2021 nearly tripled. Nearly tripled. So when I talk about the S&P 500 going up 100% during this rally, small caps went up almost 200% during that rally. You got to have perspective when you look at the stock market. So yeah, this group's been weaker, but should we ignore the fact that it was stronger before? Should we ignore the possibility that it's going to be stronger as we move forward? I think it would be very bullish for the overall market. We want wide participation. Folks are saying we're lacking breadth. We weren't lacking breadth in 2021 when small caps were doing well, but now that they're lagging, all this problem about breadth. Do you see a breakdown on the chart? Because I don't. We were very overbought after 2 years up. We came back down, put in a double bottom right at price support. And now, in my opinion, we're turning back up. I don't see that as bearish. Others might. Difference of opinion. All right. It is 9:30. So I think we're going to go ahead and wrap it right there. Let's take a look, see what's going on with the market. We had futures up slightly and Dow down slightly. Now we got a little bit of movement in the NAS today. That's a good thing. Netflix, you can see, having a good day. Another good day for Tesla. Tesla's been on a roll. Want to know why the XLY has been performing better? Take a look at Tesla and Amazon charts. They both look awesome and continuing to move up. Small caps, look at small caps up almost another full percentage point. Mid caps up not quite as much, but still on a relative basis to the S&P 500 doing well. Check out the VIX. Now under 14. Bear markets, they get squashed when the VIX goes under 16. They get squashed when the VIX goes under 16. The VIX is 1390. Good luck to the bears. That's it for me. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. Have a great day, everybody. Happy trading.